What message did the Bank of Canada send earlier this week to Canadians at its most recent monetary policy decision and subsequent press release? This is a big topic. Bank of Canada is actually shifting gears right now. And I want to take an opportunity and unpack that language, talk about what they're saying, what they said, what they didn't say, and how that's going to move markets. And it could signal to Canadians many different things as we start to see all this roll out in the media. So we welcome you back to the channel. I'm your host, Anthony with InTouch Mortgage Solutions. It's Friday, it's Finance Fridays, and we welcome you back. If you haven't subscribed yet, please hit that notification bell, hit that subscribe button. Don't forget to like and share the video, and more importantly, let us know in the comment sections below what you think is happening in the Canadian economy. So as we start off, the Bank of Canada came out on the 24th of January. They came out basically, talking about where they stand when it comes to monetary policy, what the Governing Council has decided in their opening remarks or statements. The Bank of Canada meets 8 times a year. We now have 1 off the books. We got 7 left. And this gives us a definite timeline on when we can see the Bank of Canada potentially cutting rates, right? Are they going to be cutting rates? When are they going to be cutting rates? This is the conversation that many went in, the expectation. And although I believe that the Bank of Canada was not going to cut rates at this particular meeting, I was a little bit wrong when I thought that the Bank of Canada was going to come out really guns blazing, being super aggressive or hawkish in their language. And it really wasn't the case, marking a really interesting shift in where the Bank of Canada stands. So let me unpack that thought. If we were to be in 2023 and see inflation numbers tick up the way they did in December, we would almost be guaranteed a potential rate hike by the Bank of Canada at their meeting. But we saw the inflation numbers tick up in December and readjusted back in November, but the Bank of Canada held the line and held its policy rate at 5%. Now, why would the Bank of Canada hold the rate at 5%? What data, what information is being conveyed to the Bank of Canada, to Canadians about the Canadian economy, right? So let's look at that. The Monetary Policy Report, which is issued for January of 2024, this particular document actually really opens our eyes to some things that we've been talking about on this channel. And I'll put the link to the Monetary Policy Report in the description box below so you can take a look at that data for yourself. And we'll look at some of these charts, and I know they can be sometimes confusing. We get questions all the time saying, Anth, I watched that, I saw that, what does it mean, right? Looking at these numbers, what does it mean? Let's simplify it. The Bank of Canada in their monetary policy report is literally pointing to the fact that GDP, the growth in Canada, is stalling out, if not flat. And if you put it against other research, it could show that the Bank of Canada might be off on their numbers. Some are saying, hey, it's negative. That's not a good place for the Canadian economy, especially with higher immigration levels that should be propping up GDP or propping up growth. Remember, if you have more people in the economy, there's more people consuming. More people consuming means that you'll have more spending generally in the economy, but that's not the case right now. And we also have lower unemployment. We have, higher unemployment numbers, lower jobs being created in the economy, and that's definitely not good. So we're putting that all together and saying, okay, economically, Canada's not really in a good position. Underlying all these other problems, the Bank of Canada is seeing that inflation is sticky, right? That we're gonna get, those numbers in the 3s, maybe for some period of time. But the Bank of Canada is confident that inflation is on its way down because of what's called base year effects. And they're looking at those numbers when you compare a previous data point to a current data point, how those numbers average out. And as we enter into 2024 and we ride out, those numbers should come down. But there are certain things within those numbers that are still a little elevated, those core numbers. So they've pointed to this in their monetary policy report. We talked about this last week. We knew that this was the case, right? We knew that the Bank of Canada is going to see all this data. They're going to look through those inflation numbers and say, you know what, we better pause. And the reason why they're pausing is because they know that if rates are right now in a restrictive territory, if they were to bump those up even more, they could literally turn the economy or turn it over into a recession at the drop of a hat. And they're really conscientious about that. Now, the Bank of Canada will definitely pick, raising interest rates over inflation creeping back up. We've learned this lesson. The Bank of Canada has come out on numerous occasions saying we don't want the late 1970s and early 80s to repeat itself. And that is sort of the underlying theme that the Bank of Canada is really taking. They're saying, look, we're going to keep interest rates level. The conversation is now shifted from we're not thinking about hikes. We're now thinking about when to cut. Have we done enough? Is the Bank of Canada done enough? Have they impacted Canadians through higher mortgage interest costs? Have they really done the damage? Is the monetary policy worked enough? And the answer is yes. We're seeing supply and demand come back into line where we're not seeing that same the same numbers, same conversation points where, hey, we have too much demand and not enough supply. Well, now the demand is pulling back and the supply is now catching up. And the Bank of Canada sees that. So what does all this mean? Well, the Bank of Canada is coming out with some not aggressive language. They're going to come out and say, look, we are monitoring the situation. They can't come out and say straight out to Canadians, yeah, we're going to cut rates by June, July. They're not going to do that. They can't do that. So this is why I always laugh when these reporters ask, when are we going to see rate cuts? Like there was, I think, 5 or 6 times that the Bank of Canada was asked the question, the Governor Tiff Mecklem was asked. And it's like, what a waste of an opportunity, right? Like, that they're not going to answer these questions because they're not going to give Canadians this false sense of security to say, yeah, we're going to cut it at that particular point. Not only because these numbers, these GDP, these growth numbers, these inflation numbers, they're moving targets. Right? They are moving the goalpost. As the data rolls out, so does the market. The market shifts with that data. And to say, yeah, we're going to cut rates at a certain point, that gives everybody a due date, right? It gives you a date to anticipate. And that is problematic for the Bank of Canada in many ways. Obviously, if we look back, we rewind back to 2020, we heard the Bank of Canada come out and say that they're going to keep interest rates lower for longer. And if you're going to take on a mortgage and you're going to go out and invest, do it now. Interest rates are low, we got you. That obviously didn't age too well. We know interest rates couldn't stay lower for that long, but that also now begs the question, are interest rates going to stay higher for how long, right? And this is where these cycles come into play. And the Bank of Canada is still reeling from that, reputation shock. A lot of people, not too happy with the Bank of Canada. And, everyone has their own thoughts on what the Bank of Canada should or should have not done. But at the end of the day, their job, their mandate, they've came out and said, look, we got to get inflation back down to 2%. Only way to do that is literally make the economy stall out. Like hike those rates all the way to the top as high as we can possibly go, slow everything down, and then we can always reverse course by bringing rates down. And that's where we're starting to get. The ship is starting to hit the port where we're seeing in a distance the potential for these rate cuts. The question is, when is these rate cuts or when are these rate cuts going to happen? And how deep, how fast are they going to decrease? And that's why that 7 number, there's 7 meetings left. The next meeting's in March. I don't think they're going to cut in March necessarily. They're going to wait for the February data. We've talked about that. But the sentiment shift for the Bank of Canada, if you watch that press conference, it's clear as day, at least to me, that the Bank of Canada is done with the hikes. Even though they were asked the question, are you done with rate hikes? The Bank of Canada is also not going to answer that question. They're not going to come out and say, oh yeah, we're done with rate hikes. Don't even think about it. What signal would that send to the economy, right? They have to be very cautious, picky, and choosy on what they say and what they don't say. And what they're not saying is that they're not taking rate cuts off the table, nor are they taking rate hikes off the table. But when you look deeper in the data, you listen to what they're saying, the economy is not performing. They know darn well that they need to start cutting rates at some point. The question will be when. And if we start to take that information, you listen to the clip, here it is just for you to take a listen. You let me know what your thoughts are and how you would perceive this conversation.
As always, Governing Council was focused on the decision at hand, the current policy rate. And there was a clear consensus to maintain our policy rate at 5%. We did, of course, discuss where we see the economy and inflation going and what that could mean for monetary policy going forward. What came through in the deliberations is that Governing Council's discussions about future policy is shifting from whether monetary policy is restrictive enough to how long to maintain the current restrictive stance. That doesn't mean we've ruled out further policy rate increases. If new developments push inflation higher, we may still need to raise rates. But what it does mean is that if the economy evolves broadly in line with the projection we published today, I expect future discussions will be about how long we maintain the policy rate at 5%.
So listening to that conversation, I'm pulling from it and other parts of the conversation as well that the Bank of Canada is literally now on the rate cut train, right? They're looking at where things are going to be headed. And if we take that as a Canadian who's maybe in the market for looking at real estate, maybe you're looking at your mortgage situation, the Bank of Canada isn't always concerned about housing. It's not even in some of their base cases. They know that if interest rates drop, that the housing market can basically reignite. They've talked about this before. They've said that, we didn't expect home prices to stay as strong as they did, even with the adversity of higher rates. And, they know that the real estate market is going to do its own thing. They are going to track it, but they're concerned with inflation and the economy. And right now, inflation is coming down and the economy is going to the tanks. It's tanking right now. So that's what they're focusing on. Real estate will be a byproduct. The Bank of Canada back in 2020 knew, if they drop interest rates, they knew that, that's going to spur on housing. And I mean, like Canadians see low interest rates, they're going to go spend. They're going to go blow their brains out on spending. And if we start to see some things change here in the economy right now, I can almost bet that it's going to be the same thing. Maybe not at the same level or the same pace, but it's definitely going to move the needle. We're starting to see that data, right? Even the Bank of Canada's most recent survey that we talked about last week, I was reading through it further, and there's even a chart talking about newcomers to Canada that are renting who are going to be pushing housing demand. The type of people that are arriving here in Canada, they're coming with money, they're coming with jobs that are paying well. And as soon as they're able to, they will purchase a home. They have the income and the deposit and down payment to do that. And that's literally putting additional pressure onto the fact that the current state of the housing market is still, we're not producing enough homes for the amount of Canadians that need them. Now, look at the National Bank survey. There was an interesting point there. They were saying for every one home that's constructed or one unit, there's 4.2 individuals that need that one home, right? So to put it in the simple terms, they build one house, but they need to build 4. If you take that number, we're not going to get anywhere close to the target that we need here in Canada by 2030, even by 2040 or 2050. They're just not building enough homes. There's no one there to build them. They're not bringing in the right skilled labor. They are bringing in, people that need to be in the healthcare and doctors. Yes, we need that because as 1 million plus new people arrive, that's going to put a lot of burden on the healthcare system. But what about the housing, right? And don't even get us started on the fact that the government knew well before, they knew 2 years ago about the influx of immigration and how it's going to impact housing costs. And they avoided that. And here we are today. We're definitely in a conundrum in Canada. And that is why I think the Bank of Canada is looking at all this data saying, yep, we are done with the rate hikes. If we start rising or hiking rates anymore, good luck, to the Canadian economy. It's already in a recessionary territory, if not already in a recession. I think we are. And generally what happens is with these, you might have indicators, GDP, definitely an indicator, unemployment, definitely an indicator, new jobs created to immigration, definitely an indicator to come. And we generally don't know that we're in a recession until we've come out of the recession. We look back and say, yep, there it is. Those are the quarters. Those are the data points. It's right there in the monetary policy report. They know it. We know it. Does the average Canadian know it? And that's basically now the TSN turning point, the Bank of Canada now coming out saying we're pivoting, we're moving in this direction. A lot of Canadians coming back to the market. Anecdotally, we're seeing a lot more applications for pre-approvals. We're seeing a little bit fewer homes maybe hit the market right now, but maybe that's going to tick up. We see a lot more homes that were sitting on the market a lot longer, right? Those ones that were sitting over 100 days or so, they're moving, they're gone, right? And where there was no offers before, now all of a sudden there's multiple offers. And what happens, what scares a lot of Canadians the most is missing that trend. And by the time it hits the media that these things are happening and you start to see those lagging indicators, remember those monthly reports, hey, sales are ticking up, home transactions are going and going. All of a sudden, by the time we realize that on the ground floor in the trenches, it's already been happening for months, right? And by the time that person gets into the market, they're already competing. And this is not a pitch to get Canadians to go out there and start purchasing a home right now, like go get your shoes, go get your pre-approval. It's just to really think about how this plays out, right? And that is what we really want to convey the message, to be as truthful and forthcoming as possible. Say, we're seeing it happening now. if interest rates drop, if the Bank of Canada cuts rates, now that they've pivoted, are people getting into the market before the rate drop to avoid the complications, the multiple offers and the competition? And will it actually work out for Canadians? So I encourage you to watch the press conference, get your own take on what they're saying, read the monetary policy report, and let us know in the comment sections below what you think is happening. But we'll leave the video here. Let us know in the comment section below once again what you think. But we're wishing everyone a wonderful Friday and an even better weekend ahead. Thanks again for clicking. Thanks for watching.